Welcome to this presentation about our housing market valuation tools. Since 2008, there have been several significant developments in the housing market, including some notable market movements in just the last few years. Accordingly, we are updating our presentation, which was previously recorded in 2018. After hitting their peak in mid-2006 and subsequently losing approximately 30% in value, home prices have rebounded strongly in many areas of the country. Even before the COVID-19 pandemic, home prices were growing at a much higher annual rate than the historical norm, pushing those prices well above their 2006 peak. After a brief pause at the outset of the pandemic, the year-over-year growth rate in home prices reached the fastest pace observed in more than 70 years. That torrid growth rate has pushed home prices to the highest levels ever recorded. Home prices today are more than 60% higher than they were at the peak of the last housing bubble in mid-2006. That raises a few significant questions. First, are we now in a new housing bubble similar to the one that built up in the early 2000s? And second, is it time for lenders to adopt different and more conservative lending practices? Before answering those questions, though, we first need to discuss the term housing bubble. The definitions of that term that are widely cited today do not provide any definite, measurable standard to determine when a housing market has entered a bubble. Instead, they offer only vague, backward-looking descriptions that recognize a bubble only after it has burst. In lieu of such inane descriptions, Kestrel Advisors has developed a clear, quantitative, and forward-looking definition that can be applied to identify a housing bubble before it bursts. Our definition provides that a housing market is in a bubble when home prices in that market are at least 20% higher than they should be. Additionally, our definition does not assume that a bubble must always burst. Just like a balloon, a housing bubble can either burst violently, or it can gently deflate over time and experience a soft landing. The challenge, of course, consists of determining where home prices should be. But Kestrel Advisors has developed methodologies to do precisely that. Now that we have clarified the standard for identifying a housing bubble, we can circle back to answer the questions we identified a moment ago. The answer to the first question is yes. According to our housing valuation methodology, home prices on the national scale have been in a bubble since the middle of 2021. We ascertain that status through the application of our housing valuation methodology, as illustrated in this chart. The blue line in this graph depicts indexed home prices from 1975 through the end of 2021. As is evident from the graph, home prices today are even higher than they were during the housing bubble of 2002 through 2006. But that, by itself, doesn't mean the housing market is in a bubble. The red curve here represents the fair valuation of home prices at the national level. In other words, where those home prices should be, according to the Kestrel Advisors valuation methodology. It is the comparison between the indexed home prices and our fair valuation curve that determines how overvalued or undervalued those home prices are, and ultimately, whether the housing market is in a bubble. As mentioned a moment ago, we define a bubble as the circumstance in which home prices are at least 20% higher than they should be. That comparison between the indexed home prices and our fair valuation curve indicates that the national housing market crossed that threshold about a year ago and is now more than 30% overvalued. I'll take a moment here to discuss our valuation methodology in a little further detail. The calculation of the curve's parameters was based on close analysis of a dataset spanning more than 120 years. That dataset, with our curve superimposed for comparison, is presented here. As you can see, our valuation curve fits the observed data very well over the entire life of the dataset, but also clearly identifies periods where the market was overvalued or undervalued. It is important to note one other point about our fair valuation curve. I developed this curve in late 2011. At the time the curve was developed, home prices had declined precipitously from their peak in 2006 and were still on a downward trajectory. This next slide shows even more starkly the divergence between observed home prices and our fair valuation curve, which indicated that home prices were approximately 12% undervalued at the time. Yet, despite that divergence, I did not recalibrate the model. I didn't have to, because I had constructed it very carefully and accurately. And within a period of just 2 years, the housing market itself bore out the accuracy of that curve. After hitting a nadir in early 2012, the housing market rebounded strongly throughout 2012 and 2013, and by August of 2014, it had returned to its proper valuation, as you can see here. For the next several years, home values oscillated in a seasonal pattern very tightly around this fair valuation curve. Home prices continued to remain fairly valued until early 2020, at least at the national level. However, as the adage goes, all real estate is local. Metropolitan statistical areas around the country, which are essentially cities and their surrounding areas, exhibit wide variability. Housing markets in some cities were already overvalued once again prior to 2020, presenting credit risks for lenders. Other cities were still undervalued during those years and presented opportunities to profitably expand lending activity. But the challenge lies in identifying which markets are which, so that lenders and investors can manage credit risk, but can also capitalize on lending opportunities. Since its inception, Kestrel Advisors has focused on developing fair valuation curves relating to MSAs all around the country, applying essentially the same approach used to develop the fair valuation curve for the housing market at the national level. The fair valuation curves that Kestrel Advisors has developed can help lenders manage risks and identify opportunities when considering loan origination decisions, or can help investors with regard to loan purchase decisions. For instance, those fair valuation curves can help to identify markets that are overvalued or undervalued, and thus determine whether you should increase or decrease lending activity. Determine what sort of loan products you should offer in various markets, whether certain riskier loan products such as ARM loans or low down payment loans would be suitable for some markets, or whether you should avoid using them because those markets are already overvalued. Establish suitable credit standards for those markets, such as the minimum FICO score, the requisite down payment, and an appropriate employment history. And determine whether the appraised value provided for the property accurately represents the property's true value, and therefore will provide adequate collateral for the loan, as opposed to reflecting an inflated value based on mispriced sales of comparable properties. The following slides provide a few examples that illustrate how Kestrel's fair valuation curves can provide guidance on those points. This graph depicts index home prices in Miami from 1975 through 2020 in blue, compared against the fair valuation curve that Kestrel Advisors developed in red. After the housing market crash in 2008, the Miami market recovered quickly. By the end of 2013, that market had returned to its proper valuation. That provided lenders a relatively small window of opportunity to expand lending activities in a minimal risk environment. Moreover, by the end of 2018, the Miami market had entered into bubble territory once again. This already presented considerable risk for lenders. Since that time, the Miami market has rocketed even higher. Between the beginning of 2020 and the end of 2021, this market surged so much that it was overvalued by more than 50%. This pattern is very similar to Miami's behavior during the last housing bubble, when this market reached a peak overvaluation of almost 100%, but then lost approximately 50% of its value. While lending standards may be stronger now, the risk of property overvaluation and strategic default still exists. Those observations provide certain insights about lending practices for this market. Lenders could continue existing lending practices without any change in lending volume or product mix, but in such an overvalued market, that could generate significant credit risk. Instead, it would probably make sense to reduce the overall origination activity for that market and to tighten lending standards. For instance, given the degree of overvaluation, it would be prudent to require 20% down payments for new purchase loans. It would also make sense, in this environment, to eliminate the use of very low down payment loans or to use them only very sparingly for the most creditworthy borrowers. In addition, it would be prudent to eliminate the use of adjustable rate mortgages and other flexible loan products that entail greater risk characteristics. The behavior of home prices in the Miami market did not appear to offer lenders a large window of opportunity to capitalize on a low-risk lending environment. Other markets, though, presented longer periods of safety and real opportunities to profitably expand lending activity. Consider the Cleveland housing market. At its height during the last housing bubble, the Cleveland market was overvalued by 40%. When that bubble burst, the market declined by 25% from its peak valuation. Cleveland then remained below its fair valuation for an extended period of time, not recovering until sometime in 2018. For a significant fraction of that time, the Cleveland market was undervalued by approximately 10%. Even after recovering, the Cleveland market remained fairly valued until the middle of 2020. That market undervaluation provided a great opportunity for lenders to capitalize on expanded loan originations. The observations gleaned from the Kestrel Advisors fair valuation curve here provide quite different insights for the Cleveland housing market than those we discussed above for the Miami market. The significant degree of undervaluation in the Cleveland market should have been an invitation to lenders to greatly expand their lending activity. Lenders could also have had confidence in offering a full array of loan products to borrowers, including flexible loan products such as low down payment loans, as well as supplemental loan options such as home equity loans and HELOCs. Lenders could also have relaxed their loan qualification standards in order to profitably expand their customer base without incurring much additional risk. Given the significant degree of undervaluation in the market, lenders' overall credit risk would have been quite low because the rising prices of homes in this market would quickly increase the equity of the property serving as collateral for the loans. The significant undervaluation in the Cleveland market following the last housing bubble offered lenders a great opportunity to increase lending activity with minimal risk, as indicated by our tools. The sustained surge that followed, which brought values back up to our fair valuation curve, would have substantially increased the value of the collateral supporting lenders' portfolios, thereby reducing any credit risk for recently originated loans. Thus, despite perceived weakness in the Cleveland market, lenders could have garnered significant profits from that market with minimal risk had they relied upon Kestrel Advisors' model and increased their lending activity. So, to summarize, the models developed by Kestrel Advisors can provide valuable guidance to lenders in the following ways. They can help lenders manage credit risk for new loan originations. They can help lenders identify overheated markets and determine when to raise lending standards. They can help lenders determine what sort of product mix to provide for certain markets. And they can help lenders identify opportunities to increase revenue by expanding lending activity in undervalued markets. We hope you found this presentation informative. If you have any questions, please contact me directly at mark.gilmore@KestrelAdvisorsInc.com.